So here we go. Top 3 things that individual investors should consider before you make your investment decisions over the next couple of weeks. And as you can see, Trump commentary threatens 25% tariffs on all goods coming in from Canada and Mexico. This has caused obviously quite a stir up here in Canada and even in the US. Watching some of the US media, they're talking about it extensively as well, because if you are importing goods from Mexico and Canada, which obviously they do quite a bit of in the US, this is going to lead to higher prices, potentially higher inflation down the road. So we're going to talk about that. Definitely something to consider before you make your investment decision. Latest economic data to watch. We got some important data today out of the US, PCE, personal consumption and expenditures, as well as the latest GDP number, growth numbers out of the US. We're going to compare those to what we're seeing here in Canada. Canadian GDP comes out in the next few days, so we'll be able to see an updated GDP number there as well. And lastly, data coming out next week will be employment data. Next Friday, we will get employment numbers, jobs numbers out of the US and Canada, I believe, as well. And our third topic to consider before you make your investment decisions, Canadian bank earnings. We're going to hear from our largest Canadian banks beginning of December. What are we anticipating? How good will these earnings reports be? So let's move on to our first topic, the Trump commentary and the threat of 25% tariffs on everything that's coming from Canada and Mexico. And obviously, this is something that will affect certain segments of our economy a lot more than others. Manufacturing, any manufacturing business that obviously exports to the United States, things such as energy, cars, trucks. It was interesting to see that energy is at the top of the list, followed very closely by autos. I think coming out of Mexico, GM does a lot of production out of Mexico, bringing those cars into the US from Mexico. I believe when the tariffs were announced, GM stock was down over 8% that day, just the other day. Our first chart here clearly shows how much the United States imports from Mexico, China, and Canada, because even China, there's talk from President-elect Trump that they will increase tariffs on Chinese goods another 10% on top of the tariffs that former President Trump put on in his first 4 years of being in office. I know President Biden did not change that, even though he was quite negative when he took office on the Trump tariffs. He kept those tariffs in place. Well, now President-elect Trump is looking to put another 10% on Chinese goods coming into the United States. So you can see here how much, looks like Mexico is the leader out of the 3 countries. Interesting enough, used to be China. Mexico is getting close to 15, 16% imports into the US. China is somewhere around, let's say 12, 13%. And Canada looks to be right there with China. So they get a lot of imports from those 3 countries. And, many people say this is just a bargaining tool. Tariffs are just the starting point to negotiate. A lot of people think that these tariffs will not be placed on Canada and Mexico, maybe not even China. But I think you got to take President-elect at his word that he may put these tariffs on. I guess it's a matter of let the negotiations begin. I know we've heard that our Prime Minister has been in talk with President-elect Trump. And according to Prime Minister Trudeau, those talks have gone quite well. So depending on what President-elect Trump wants from Canada, I believe he wants to see immigration, people crossing the border illegally stopped, drugs coming across their borders stopped. I know he's been upset in the past with respect to the dairy industry, lumber industry, many industries that obviously cross border that the president-elect is not happy with and wants to renegotiate some of those contracts. The USMCA that was created when President-elect Trump was in office the first time, he is saying that a lot of it will be maintained, but he wants to tweak it a little bit because certain things have definitely changed. Our next illustration or chart is Canada's exports to the United States. And you could see here in the last 12 months, energy by far the #1 export to the United States, and obviously sector of the market that will be affected by tariffs, followed by, there you have it, cars and trucks, consumer goods, metal products, pulp and paper. There is your lumber, chemicals, machinery, agriculture, electronics, planes, boats, and trains. A large number of industry. Not only it's not only these industries that will be affected, but anybody that supplies to these industries. So if you are an automotive parts maker, such as Magna, for example, you could see your business being affected, right? If you supply parts to the automotive industry, then definitely you will be affected by the latest tariffs. If you supply anything to the energy industry, and we know many companies provide different products to the energy industry, you will be affected as well. So tariffs, the talk about tariffs, we're going to have to keep a close eye on what happens over the course of the coming few months. If there are any other indications as to what the president-elect, former President Trump, wants and says, I think that's going to be very important before you make your investments over the next couple of weeks, and even beyond that, I guess right up until inauguration in January, and even probably into February as well. The next idea or point I want to focus on before you make your investment decisions is the latest economic data. And we always have this topic here because it is so important. And I guess the first one and the first chart we have to focus on is PCE. Keep in mind, this is the preferred measurement for inflation by the Federal Reserve. It leans a little less on real estate versus CPI, which has more real estate as a component. And you can see here that it has begun to tick higher once again. You see the core PCE, which is your blue line, moving higher to 2.8% based on this morning's numbers, and even the headline number moving up to 2.3%. This was higher from as low as 2.1% recently. So we're starting to see a little bit warmer inflation, more money being spent. We had actually some income numbers that were really, really strong this morning out of the US. People are definitely earning more, I guess, through their jobs. Spending wasn't higher, but it looks like they're saving money. And I guess if you're a retailer in the US and maybe even here in Canada, perhaps you're actually licking your chops, because the hope is that for these retailers, that these individuals are going to, the consumer is going to start to consume over the holiday season. And perhaps they've saved this money for the Thanksgiving and Christmas shopping spree. The next point I wanted to get to is our next chart, which is a chart on GDP. And we also received GDP numbers out of the US, and their second reading for the third quarter was 2.8%, very strong. This coming off a reading of 3% in the second quarter and just 1.5% or 1.6% in the first quarter. So very strong readings. And this tells, or should tell, the Fed that, well, maybe they don't need to act as quickly as many anticipated they would have to. Back in the summer months when we started to see unemployment tick higher in the US, GDP was kind of floundering a little bit. We were wondering if the Fed would cut aggressively in the fall and leading up to the end of the year. And really, they have cut. But I think the commentaries we're hearing from the Federal Reserve and the Fed governors, perhaps they go one more cut in December, on I believe it's mid-December that they have their meeting. And then for 2025, they may not cut as quick. They may take their time, maybe cut only once or twice, maybe a quarter point each time. So based on GDP or growth in the US, based on jobs, based on the consumer spending and what the consumer and how the consumer is faring, I don't think Federal Reserve has to cut rates as quickly as we do here in Canada. And one of the reasons why I say that is, look at our next chart, Canadian GDP. And we go from seeing numbers in the high 2 to 3% range to seeing numbers 0.5, 0.4, These are obviously a lot lower. We're on pace to probably do somewhere in the vicinity of, 1.5% growth this year in Canada, whereas in the US, they're probably going to come in 2.5%, 3%. So they're about 2 times larger, or their growth rate is about 2 times more than what we're doing here in our country. And that lends itself to why the Bank of Canada has been as aggressive as they have in cutting rates, into stimulating this market. And going forward, we'll have to see what happens with respect to what the Bank of Canada is now seeing the federal government doing with the rebate checks and the cutting of the GST, HST. How will that affect things? How will that affect inflation? And a lot of people are saying that the Bank of Canada might have to slow down what they wanted to do originally because of what Prime Minister Trudeau announced recently. The third point I wanted to touch on before, again, you make your investment decisions, and this one in particular affects many Canadians, and these are Canadian bank stocks, Canadian bank earnings. We're going to start to get our Canadian bank earnings in the next week, and for the most part, I think expectations are sort of tempered. I think coming into this earnings season, you have a banking sector that is slightly overvalued. At the very best, maybe fairly valued. You're looking at Canadian bank stocks trading at a multiple of about 12 times forward earnings. Historically, those Canadian bank stocks were probably in the 10.5, 11 times range. We're hearing about the consumer, that the consumer is a little more tapped, that they're not keeping up with their credit card payments and their unsecured debt payments. And so, what are we going to see from the loan loss provisions that these banks set aside, the money they set aside for bad debt? Many are fearing that we could see more money set aside. On the flip side, or I guess on the positive side, net interest margins. We're hoping to see, and we're anticipating a good number. And keep in mind, net interest margin is the difference, or the gap, or the spread between what banks pay on their GICs and, let's say, high interest savings accounts, and what they charge you for loans. And that gap has widened a little bit over the last little while. So banks benefit from that based on what they charge and what they pay. Net interest margin, the banks should, I think, benefit from that. We'll see what happens in the wealth management area. I'm expecting good things there as well, as the stock market has fared exceptionally well over the last quarter. So I think banks can be rewarded or see some good gains in that area. But overall, we don't anticipate any dividend increases. If we get those, that would be a bonus, because I don't think it's anticipated. And again, it just depends on which bank you look at. And we have charts on our 5 major banks, Royal Bank being our first chart. Royal Bank is probably one of the more expensive banks. The one bank that I no longer continue to buy for individual investors or recommend to buy. It is the strongest bank. It has been the strongest performer. And probably the most expensive bank. Shares are trading at, 13 times forward earnings, which is on the high side. But once again, we're expecting good things out of the bank. Again, lending will be a topic. We'll see what Royal Bank says. They're one of the best lenders in Canada. Next bank stock, and probably the second best performer in Canada, is CIBC. And again, you look at a chart of CIBC, and you go from the bottom left to the top right. Fantastic stock, trading near or at all-time highs. And if you've owned CIBC this year, you've done exceptionally well, 30-40% returns. It's been a fantastic run for CIBC stock over the last 12 months. Next bank stock, Bank of Nova Scotia. And as I've said on many shows before, Bank of Nova Scotia has undergone and is still undergoing a restructuring. New CEO Thompson there, and they're really focusing on efficiency, being more efficient with what they do, the type of businesses they enter in, where their businesses are, getting out of businesses in certain countries of the world that are not doing well, that are not efficient, and moving more into areas such as the United States. So we've seen a restructuring. Recently, I saw an actual buy rating put on Scotiabank. Scotiabank is trading at 52-week highs, not all-time highs, but definitely 52-week highs. And again, if you've owned shares of Bank of Nova Scotia, you've done extremely well. TD Bank, our next chart, probably the only bank that has not done well this year. And as we know, that is because of their money laundering issues down in the US. We've seen their bank stock pull back. But at a 5% dividend, I think it's worth to take a look at. And last but not least, Bank of Montreal. Bank of Montreal has done really well, a little more volatile than the other banks because they had some credit issues earlier on this year. But again, I think I was on BNN not too long ago, maybe a few months ago, and I said Bank of Montreal is probably the bank you may want to purchase because I think those credit issues will be left behind. They will they will get through it. And that's exactly what happened. And Bank of Montreal is back near 52-week highs once again. So I think overall, as part of what investors should be focusing on over the next couple of weeks before you make your investment decisions, Canadian bank earnings, most definitely. I think you want to look at the economic data. A lot of it has come out already. Focus on jobs next Friday. And definitely, most definitely, that's the topic everybody's talking about, tariffs. What will the new administration place tariffs? Will they place tariffs on all Canadian and Mexican goods coming into their country? And if so, how will that affect our investments?